Hello, beautiful people. Today I'm going to do a short video on why you just don't jump in these trades when you get that breakout and just be setting these limit orders because the market will have you in drawdown like crazy, crazy, crazy. So without further ado, I'm going to go ahead and get right into it. As you can see, I've had my chart marked up pretty much. This is my method. I mark it in half so I can know what side of the market I'm trading on. And the way I do that, I identify my swing low on the 4-hour time frame. I do my setups on the left, so I identify my swing highs and signal candles on the left. As you can see, there's a zone here, there's a green zone here and here as well. And now I know that I'm looking for buys at this moment, or I'm waiting for something to happen around these structure areas, whether the market will turn around or break above. Now, as you can see on the 4-hour time frame, the market did close above this this zone right here on the 4-hour time frame and pull back. A lovely entry for a buy. Also on the 1-hour time frame, this is what I wanted to show you guys, is that in the next zone, I saw that the market had broke above this zone, and I see that there's an inverted head and shoulder. So let me tell you why you should not just jump in these markets just because you see this bullish momentum. Because initially when I saw that breakout, I was like, oh, let me drop to my 15-minute, mark up my magic fibs with my zones, and go ahead and set my limit order for buy right around this area. That was my initial reaction. And then I stopped and I thought about it. I was like, hold on, wait a minute. Did I confirm that this market is going to continue back up, or is going to go back down? Had I entered in this trade, I would have been in drawdown from here to here, already 50 pips. Okay, that's something you wanted to avoid. So one of the things that I remembered that I needed to do is follow my rules, which states wait for the pullback, mark your zones up, and then confirm that there's buying momentum and the market is going to go back up. And the way I would do that is, now that I'm in the 15-minute time frame, I'm looking for starting points, whether you're using the original starting point strategy or just your same one, your signal candle swing high. I'm looking for the market to show signs of bullish momentum. And the way I can do that is, since I used to swing low, swing high, I technically have to wait until a candle give me a swing low, which it has not. So right now, I'm just sitting on my hands waiting. Now, if you decide to use the normal breaking structure starting point, you could go ahead and mark your zone right here, because this was the last buying candle that had pushed the market down and broke this structure. And you can go ahead and set your alarm, and that could be like an area of interest. Now, one of the ways that you can increase your risk to reward ratio is, if you're looking for a better reward, you can enter on the minor structure. Once you see that there is a candle that closes above as confirmation, at that point you would get out, you would set your limit order and take the buy up. Okay, now at this point you will already be in the market a lot sooner for those than the people who are waiting on the 1-hour time frame for the candle to close. Remember, on the higher the time frame, more than likely you're already behind and getting in the market, and that could mean a difference of 10 to 20 pips. But it is more less riskier because you don't have that many fake outs on the higher time frame. So you got to figure out what matters to you and what kind of trader you are. Once again, if you take trades on the minor structure, which is the lower time frame, you're in earlier, it is more riskier at that point, but your risk to reward ratio, it could be higher. And what I mean by that is, if I want to go long here at this point, I'm already in the trade and I'm almost at a 2.5 risk to reward ratio. Okay, that's twice as much pips that I'm going to be risking if I was going to get in on the 15. But if I waited until the candle closes on the hour, then this market at this point is already up, and I'm waiting for the candle to close above right here, and then I'm going to be drawing my zone for my fibs at this point, once I get this, whatever that swing low would be, you could still use this zone if you want to mark it on the lower time frame and wait till it closes on the higher time frame. At that point, you'll be getting in a little bit later into the market, and more than likely it'll be a little bit higher than this. So you will be risking a little bit more. The risk could be the same, but your reward will probably be more than likely less. So figure out what works for you. I just want to show you why you shouldn't just hop into these markets. We'll talk about risk to reward ratios in another video. Without further ado, stay tuned to the next one. I love you guys, and if you need me to explain this a little bit better, feel free to let me know in the comments, and I'll do another video. Take care.